Yo, 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 what's happening, traders? I hope you guys are well. I hope you guys are amazing. I know I am. Thanks for asking. But look, guys, I also want to break down this trade we took on NZDJPY. Closed out at a 1 to 43 R&R and 1 pip stop loss as well, which is absolutely crazy. Now, I do believe this trade has potential to potentially go even higher. As we can see, it's still currently playing out. And I still believe it has a lot of potential to go a lot higher, maybe even clear 1 to 183. But hey, we closed out here. We still have some positions riding on a separate account, but that's besides the point. Let me really walk you guys through this analysis and really show you guys how we can get these sniper entries and have sub 1 pip stop loss. You can see 1.1 pip stop loss here. So let's just quickly replay the chart to obviously where we saw it, and let's go ahead and get right into it. So how we actually saw it, obviously we saw it here. The entry point was there. So if we just clear the chart right now, let me actually walk you guys through this trade. Now, the first thing I saw, right, I always start on the higher time frames. Now, the first thing I saw was I started on the monthly time frame. Now, just looking at structure on the monthly time frame, I could see that, obviously we've been getting these lows, lower highs, lower lows, so it's potentially bearish. But again, this is a monthly time frame. Now, what we can see is this institutional candle here. Now, on this institutional candle, what we can actually do is we can mark up the open price of this candle and the 50%, because this is where potential institutions brought before they sold. They push price up before they push price down. See, they buy before they sell. But see, institutions and banks, they have to hedge themselves into positions. When markets can make big moves like this, again, on such high time frames, we're talking at multiple thousands of pips of moves, the institutions have to engineer price significantly higher. So what they have to do, they have to buy to the market before they sell the market. Why? Because if they enter a buy position, guys, they're trading with millions of lots. Not one lot, not 20 lots, not 100 lots. Guys, they're entering trades with hundreds of thousands and millions of lots. Meaning when they enter these trades, they can physically manipulate and move the market to higher or lower prices that they desire. So what they did here is they actually manipulated this price up here. It also, anyone who was going short above here got taken out of the market. Their stop loss got hit. And obviously this captured their liquidity, giving us a valid institutional candle. Now, I know the market does look bearish on a higher time frame, but again, is this relevant to current price? Yes and no. It's in that area. It's in a potential interest. We are getting a slowdown of price, but when we actually look on a lower time frame, such as the weekly, we can see that we've got liquidity. We've got these weekly highs. Now I can get rid of these two lines here because we know where price is and potential sellers can show. So we've got a double top here. Now this double top is not a bearish formation. Matter of fact, this is a bullish formation. If anything, see guys, traditional retail tells you to sell there. It's a resistance level. No, that is wrong. There is liquidity above it. There are stop losses above it. Retail traders around the world, guys, over 95% of retail traders lose money in these markets. So most retail traders come on Google and type in, Forex chart patterns, Forex chart patterns. And they're using all these different, basic patterns. Guys, there's a reason why double tops don't work. There is a reason why how many Forex traders lose. Guys, 70, 80, 90+% of Forex traders lose money, 95% here. You see how do we trade? Okay, cool. How do we trade is very, very secret. I'm going to show you guys. Now, there's also this gap in price here, which gives you a true support and resistance level, a true inefficiency, which we could see the reaction from in the future. Now, again, this is still a weekly time frame, right? It's still very, very high time frame. So let's drop it down. Daily time frame. What can we see? We can see that price has created this little consolidation range here, this little consolidating range here. Now, again, I didn't really see too much on the daily time frame, so we scaled down on the 4 hour. Now, on the 4 hour, what does it look like price is doing here? You see, what price has actually done is price has actually cleared some liquidity. We've cleared these equal lows. So anyone who stop loss was below this support level there got hit. Anyone's above here got hit as well. Now now again, let's look at current price. Current price is obviously here in this area here. Now what we can actually see now is if we look within here, let me quickly to make this clear. There we go. We can see that price is starting to kind of diverge right now. This divergence, guys, plus there's a lot of inefficient price action, a lot of imbalance, a lot of gaps in the market or here that needs to come and get taken care of. But in here, if we scale down on a lower time frame, such as an hourly time frame, we can see price starting to accumulate. Now, if you've never seen accumulation schematics before, Let me quickly just load them up and I'll show this accumulation schematic. Now, how the market moves is very methodically engineered, guys. The market is not random. The market is systematically engineered on every single time frame. And one of the best ways it creates this school of thought here. Now, we have these accumulations. We have the markup, reaccumulation, distribution, markdown, redistro, markdown, and so on and so forth, right? Now, we can actually look at these points of interest in the market and start to get more clear on what they're really showing us. So if we actually look here, we can see a classic accumulation schematic, right? We'll get that preliminary supply, selling climax, automatic reaction, secondary test, up thrust, secondary test in phase B, spring with a test and all those LPSs. Now, on Wyckoff, we're trying to enter off this test and in the LPS phase, we're trying to enter in that C and D phase ideally. Ideally, the D phase is the most safest. But let's actually take a look on the schematic now. So again, this is still on the hourly time frame. You know, a good way to spot schematics as well is just looking for the free drives. 1, 2, 3 drives in price. Now, if we scale it down to, let's say, a 15-minute now, what can we see? We can start seeing this schematic occur. We can see that, you know, that preliminary supply. We can see that preliminary supply. Let me make this text a little bit smaller. We can see that preliminary supply. After this preliminary supply, what do we get? We've got a seller's climax. After selling climax, automatic reaction, secondary test, little sign of strength. After our sign of strength, what do we get? We got a secondary test in phase B. After our secondary test in phase B, we had that consolidation. Opinions were getting formed in this area here. After that, we got that final spring, that final shakeout, So anyone who was using this resistance level to try and buy here, obviously got their stop loss here. So what happened now is price came back to test, to give us a test. So if we pull up the schematic again, we'll be able to see that this is very, very similar to obviously what we are looking at, right? Preliminary supply, selling climax, automatic reaction, secondary test, sign of strength, second test in phase B, spring and a test. Now that shows us that potentially if this is a valid accumulation, we should not go lower than these current prices. Now again, this is on a 15-minute time frame. So let's scale down because I like to really get precise on my entry points. So we actually entered this based off a 1-minute time frame. So based on the 1-minute time frame, what we can see after this test is price then, well, it's actually a 5-minute, but if we look on a start scaling in and look at structure, we can actually see what happened to price. Price started to do what? Started to get these higher highs, higher low, higher high, higher low, higher high, higher low. Obviously a big manipulation, big shakeout. And I guess you could have ended off that if you wanted to. But where did we go ahead and enter the market? You see, where we went ahead and entered the market was actually somewhere very, very nice. Oh, it actually cut out. But then let's go back on the 15-minute time frame. I'm not too sure where it cut out. But obviously we see price starting to push up in that spring phase after the test. Now, after that test, what we can actually go ahead and do is if this is a valid test, we can simply go ahead and enter. So if we look at all this price action here, any imbalanced price action here, any liquidity got taken care of by this. Now, these wicks as well, they came back to come and fill any open orders that were left, down there. Now, what actually happened after that price started to rally away, right? If this was a true downtrend, lower low, lower high, it should create a lower low. But what happened? It broke structure, higher high, higher low, coming up to now create a new higher high. So as price started to come up to create a new higher high, so what happened? It then broke structure on a 5-minute. Now, if we scale down, what we can actually see is where price started coming down to is our point of interest. So where was our point of interest? Again, if we look at the structure, lower, higher high, higher low, lower low, lower high, higher low, higher high, higher low, higher high, higher low, higher high. Breaks of structure, break of structure. That shows you that you can go ahead and now look for potential buy positions. But where do we want to look for? Where do we want to look for potential buy positions? You see, price here, that looks very aggressive to some people. But you see, what you want to always be doing is buying lower and selling higher. So if we look at our Fibonacci tool from swing low to swing high, we always want to be getting in those discounted prices, anything below the 50%. Now look at this. We've got our 786 and 886 levels in the market. These are very powerful levels of demand in the market or supply. Now, I don't even need to use the Fibonacci because I know it's clearly below the Fib, the 50%. So where are we looking for the point of interest? Well, we can see that we have this last down close candle before the up move. Now, that's how the banks move the market. You see, what they do, they'll sell the market, if I put on the background, they'll go ahead and sell the market, guys, before they have to buy the market up. Now, what happens then, guys, when they have to sell before they buy? Why do they do that? Again, they have to hedge themselves in. They have to enter 2 trades. Otherwise, if they enter in too many trades, it's not gonna it's not gonna look pretty on the chart, guys. The market will move so rapidly, and you'll get like the disgusting drops, like that, quick flash crashes. You know what I mean? They had to rebalance themselves in the market. But like some things that will be disgusting. You see some bigger trades like that. Boom, big flash crashes. Now, what you want to do is they sell before they buy. Now, what happens, guys, is the bank, they have one order here because they're opening the candlestick. They have one sell position that's open there. And the rest of their sell positions, we can mark up between the open and the 50%. So why the 50%? Because that's the average of where all of their selling positions will be. So we can mark up the open and the 50%. Now, after we've marked up that open and that 50%, this can become a future point of entry. Why? Because the banks, guys, what they did is they entered one sell position here, or probably a lot. So let's say they're down, negative, I don't know, because obviously when they're down there, they sell, let's say, 1 million lots, right? They sell 1 million lots. Now, what they do, they get a discounted price. They can physically manipulate the markets, guys, and move it. You can Google, Forex market manipulation. Like all these big banks, guys, they literally manipulate the market. Look at this, Barclays fined 2.4 billion for Forex rigging. Look at all these UK banks fined. Look at all these Royal Bank of Scotland, guys. So many different banks, JP Morgan, Citibank. Guys, they manipulate the markets. They manipulate the market. So that's how they manipulate. They sell, and then what they do is they buy. Because why would you want to buy up here when you could buy at a more discounted price? So now buy, let's say, 10 million lots. And that's why the market moves so aggressively. Now, have you ever entered the trade? It's hit your stop loss and then directly rallied after? Yeah, because that's market manipulation. So what they do now is that buy position, guys, they don't use stop losses. That buy position is obviously pushed all the way up. So as the market's all the way up here now, that sell position is in drawdown. That sell position is in negative. Let's say that sell position will probably be negative, I don't know, let's say 50 million, for example. Now, what they're going to have to do, they're not going to take losses. They're now going to bring price back down to their entry point so that they can go ahead and break even their trades. And that's where we enter. And then boom, move the price up. So if we apply that same logic, now to the market, it works, vice versa as well. If we apply that same logic here, what do we see? We saw that the banks, they sold black candle before they brought. Now, what you can go ahead and do is you can mark up the open and the 50%. And this now will become a future point of entry for the market. So what we did, we simply went ahead and entered off this. Stop loss can go just below the low. That's not even 1 pip stop loss. And now where are our take profits? Now the first take profit were these equal highs here. If you was very conservative, but again, because it's a Wyckoff schematic, guys, Wyckoff trades should just blast. It shouldn't be these quick trades. So again, that's already a 1 to 3 risk to reward, meaning you risk 1%, you make 3.6% in return. You've got another set of equal highs here. Liquidity. Stop losses are above that. Why is it called liquidity? Because all the retail traders are seeing double tops, double bottoms, strong level of resistance, and they put their stop losses below that. So that's already a 1 point. That's, guys, 4 pips, and you're going to make 5.5% profit if you risk 5%. Now let's look for some higher time frame targets, because again, we have the higher time frame analysis. What do we have? We have imbalance. We have inefficient price action in this area here. It's another target. Oh, didn't mean to move it. That's another target. What's that? That's already a 1 to 7.5. Now again, we know there's stop losses above single highs and double tops. There's going to be stop losses here. There's going to be liquidity. There's going to be money above here. So that can now become a future target. Because again, this is a true Wyckoff schematic. It should absolutely blast from the test and the LPS. Now we've got obviously all this inefficient price action down here as well. All this inefficient price action here that needs to come and get filled in. Again, we have the double tops on a much higher time frame. Now, I did close out earlier. I'll show you where I closed out. I closed out around these areas here. So if we investigate here, we can see another area where the banks brought before they sold. Now, because they brought before they sold here, that means that their orders are in drawdown. So because their orders are actually in drawdown, that means that they want to come back to mitigate this play. Now, if I look at the number on this, what is this? That's 70.23, 70.232. We can make that a round number of 70.250. And that still fits in that candle. That still fits in that institutional candle. And I bet if we went on a 1 minute time frame, we could probably get a bit more accurate and find like another candle in there. Yeah, it's right at the top. Yeah, perfect. So check this out. Now, what happened? Price then comes to our entry point. Again, this was an Asian session, it's NZDJPY. So boom, comes in, fills us in the trade, and then from there, it absolutely rockets. Absolutely rockets. Absolutely rockets, mate. Ready, reaccumulates again before absolutely blasting off for that that's technically 1 to 20 there. But what you could have done as well is you could have targeted again that 70.250, right? 70.250, which is what we targeted. Now, in this analysis here, that's saying a 1 to 50. The trade I specifically took was actually a 1 to 40 because obviously you have to give it a little bit for spread. So make the stop loss a little bit bigger. Now, boom, if we continue to replay the chart, price absolutely went off on one. This trade may be a nice amount of money as well. A very, very substantial amount. Now, I did close it. I do believe price does have potential to go a lot higher, but that's why I've got some other positions open on a separate account as well. But yeah, you know, price absolutely went for it. It completely smashed the target. And obviously, if we see where current price is now, price is still continuing to move and continue to move up. So again, even if you didn't take profits there, and it wouldn't have stopped you out because look where your stop loss is. You'd be at break even anyway. And then yeah, guys, no, yeah, that was a banging trade. You know, that was again 1 to 40, meaning if you risk 1%, guys, like this is the power of risk to reward ratios. Now, if you're taking a 1 to 42 risk to reward ratio, guys, you can lose 40 trades, 41 trades in a row. You win one of these trades, your account's back at the same place you started with. You see what I'm saying, guys? The power of these analysis. 1 to 42 risk to reward. You risk 1%, you can make 42% of your account on that trade. 2%, you make 84% on that trade, and so on and so forth. Like, guys, the only thing you can control in this market is your risk. See, a lot of these traders are going for 1 to 1s, 1 to 2s. Guys, it's not worth risking £1 to make £2. It's not worth my time. Anything really less than a 1 to 4, 1 to 5 is not worth our time. And again, that's where current price is now. If price does manage to continue up, okay, we've got some orders on the table. It can do it. Look, guys, it can do what it wants to do. Like, I don't care. If it wants to go higher, it goes higher. We know that the other trade, we took the majority of the volume off the trade. Because again, that is over a 40% ROI on one specific trade. Guys, this trade happened in 4 hours. This wasn't a swing trade, guys. This trade literally happened in, look, from entry point to TP, 4 hours, guys, and 45 minutes to make 42%. Guys, you had 100 grand, you make 42% 100 grand. That's over 40 grand right there on one trade. Well, my maths might have been off there. But hey, you ain't got to be good at maths to make money. That's the thing. So anyway, guys, look, I'm going to leave it there. If you have any questions, guys, feel free to reach out to me on Instagram. This was a live account traded. You know, screenshots will be posted of entries and the real account to show. But here's my Instagram, guys. If you have any questions and want to join our trading community, and you want to actually learn more about how we take these trades on a regular and how we show our new students to be positioning themselves and earning money from the market whilst they're learning, guys, definitely send me a message on my Instagram. You're more than welcome to shoot me a message on my WhatsApp, +447968835 UK number. So if you got WhatsApp, you're more than welcome to shoot me on there. Ask me for more information. I'd be love to help you guys out. But with that being said, guys, I'll see you all at the top because the bottom is way too crowded.